Welcome to the Retirement Roadmap by SHP Financial, a podcast empowering today's retirees and pre-retirees to make well-informed financial decisions that will help you spend more time living and dreaming than worrying and wondering. Join me, Matthew Peck, along with my co-hosts, Derek Gregoire and Keith Ellis, as we share actionable financial strategies and insights, as well as interview top thought leaders in the world of finance, accounting, and estate planning. This is all aimed at preparing you for the retirement you've always dreamed of. Our high-quality holistic planning process has helped thousands of families retire and create what we like to call the ripple effect. The Retirement Roadmap is your guide to financial freedom. Are you ready to get started? Let's go. Welcome, everyone, to a very special edition of SHP's Retirement Roadmap podcast. I'll be your host today, Matthew Peck, and today we're going to be talking about banking. I must admit, about a month ago, I would not have said that I am a banking expert and understand all of the inner workings of how a deposit base and an asset base and all of the important inner workings of a bank is. But yes, obviously based on some recent history, we felt that it was a great idea to share the information that now that we've had to digest over the past 2 weeks of since some of the recent Civ or Silicon Valley Bank failure, the regulators seizing Signature Bank, First Republic. A lot going on, and we wanted to make sure that we let everyone know, all of our listeners know, and whether it's clients or just listeners, know what our thoughts are. As I mentioned, as we've been able to digest everything and really let you know what the outlook is, sort of what it means to you. And also, I'll sort of say it now, is that this podcast is going to come in two parts because right now as we speak, the Federal Reserve is meeting. And so we're going to end on a cliffhanger today, ladies and gentlemen, because we don't know what the Fed is going to do, whether or not they're going to continue to raise rates in the face of some of these issues, some of these global banking issues that we'll talk about, or whether they will pause. And so there's a lot of activity there. And so let me pause and kind of begin, or start at the beginning, if you will. And in our opinion, there's nothing so timeless, or what happened with Silicon Valley Bank, and forgive everyone, I'm just going to call it Civ Bank because I'm just going to stumble over Silicon Valley Bank, constantly. So locally, I'll just call it Civ Bank, right? Something about that bank run, it's both timeless but also modern. It's modern in the sense of, hey, it's Silicon Valley, it's tech, it's VC, it's people pulling money out by swiping left or swiping right. Imagine sort of the technology as to where we are now and how easy it is to withdraw money from your bank. You're no longer having to go down there or anything like that. You open up your banking app and there it is. Money's now gone into wherever you want to send it. So there was something obviously very modern about it. But at the same point, it's also timeless. This happens to banks. It has happened numerous times in the past. And obviously that's what sent off so many different concerns and uncertainty when it comes to it. Even me personally, it's just like a bank can't fail. It's a bank. What's more boring than a bank to a certain extent, right? It's old and staid and has the columns and it's been here forever and banks are just well run, lending out here and there and slowly but surely, life moves on. But when banks fail, I think it's whether it's that idea of the institution itself, or whether it's you do have these concerns. Okay, is it going to be another 2008? Is it going to be another Great Depression? And there were, in fact, again, those timeless images of people waiting in line outside of closed banks, kind of peering inside, like, okay, what happens now? I mean, it might not have been, It's a Wonderful Life with everyone clamoring for their funds and Black and White and Jimmy Stewart, but there is that aspect of that panic that can happen. And so a little bit later too, after I talk about the kind of specifics, I do want to digress a little bit into some of the other timeless decisions or debates that happen when companies fail, when specifically banks fail. How much regulation should there be? How much saving? How much should the Fed stop or step in to contain, to stop the contagion versus letting free markets ride? So I will get a little nerdy there as we go throughout. And I think too, talking about this whole idea on the podcast is to make sure, let a self-described nerd like myself research through all this information and then provide the most sort of salient points to all of our listeners and to our clients to find out, okay, does this really matter to me? Or how does it impact me? How does it impact the portfolios? What plans or anything are we doing in the macro and the markets and all of that? So I'll certainly be breaking that down as I meander my way through, the current banking crisis. So with that in mind, let's isolate on the modern aspects of it in the sense of let's isolate on Civ Bank itself and find out, okay, how did this all start? Because there are some very specific pieces to the puzzle that could only have happened in 2023 or 2022 as we go into this, okay? So first, let's take a look at what's called the depositor base, okay? And it's good to understand who Civ Bank's clients were. Civ Bank's clients were VC firms, or what's called venture capital. So think of a VC firm, or a lot of their clients are the startup companies that just got a lot of money. So that they made a pitch at this board to say, hey, this technology or that product or this widget or whatever it may be is going to change the world. And the VC says, you know what? Great. We're going to give you $1 billion to get that company off the ground. Obviously, we're going to have ownership. And so it's this great little, what's called like incubator, which is like, okay, there's a lot of money with these firms there's a lot of firms that have a lot of money and they want to have these startups grow. So now the startup gets the money and they say, okay, I'm going to pause it in the bank. So there's a lot of money coming in with these clients all at once that are going into the bank. And I'm going to come back to that later. And so these are companies that they're not your mom and pop, right? These are people that have got a lot of money all at once, and in fact were over the FDIC insurance. Meaning that, okay, if I have a lot of money in a bank and now there's whispers and tweets that bank might fail, well, I better pull it all out now. I better shoot first and ask questions later, because of the fact that, okay, well, I'm only insured up to $250,000, and if I have $1 million in there, well, that means 750 of it is completely, up to the wind, and now I hear that they're having issues. Yeah, I'm pulling it all out now, right? So if the depositor base are sort of, kind of more business oriented, less sticky, as they say, and have all this money that's over and above the FDIC insurance, yeah, they're going to be a little bit more flighty if there's winds of the bank failing. And in fact, at the end of 2022, $152 billion of Civ Bank's $173 billion were uninsured. So a heavy majority of the funds were uninsured of these companies that needed to make payroll. And so once the wind started to change, again, swipe left, swipe right, those funds are moved away from that bank. The bank run is now started because, hey, this money's not insured and it's over and above the 250. So now let's talk about, again, the modern aspect of, okay, why did this start? Why were the whispers started there? Well, why did this happen now? And that's why, and you might have seen some news, but that's why a lot of people are blaming the Federal Reserve. Because when the Federal Reserve raised interest rates so dramatically, like the most in close to 40 years in 2022, it hurt banks, or most banks, and specifically I'll talk about Civ banks, it now hurt their asset base. So I talked about their depositor base. Now let's talk about their asset base. Well, as I mentioned, in 2022 or 2021, obviously 2020, 2021, et cetera, a lot of easy money out there flowing into banks, right? Flowing into the economy, flowing into VC, flowing into tech, flowing into those types of companies that are now getting that money to invest this widget that is going to change the world. Company then says, all right, well, what do I do with this $1 billion I just got from a VC firm? Well, I'm going to plop it into Civ Bank. They're local. They're great. They're part of the Silicon Valley community, right? Okay, well, Silicon Valley is getting all this money, and what do banks normally do is they buy bonds. And at that point, when interest rates were really, really low, well, they were starting to get a little bit of yield on their bonds, but not much. Well, now inflation starts to get sticky. Now the Federal Reserve starts to raise interest rates. Now the bonds that Civ Bank bought, during that time of easier money and less tight conditions, now those bonds are dramatic. And for anyone that had bonds over the past year or so, bonds in their portfolio, they lost value. And so they got this big rush of cash at a time where they sort of bought high in the bond market. And then the minute that interest rates started to go up and the Fed started to raise interest rates as dramatically as they did to curb inflation, now the asset base of Civ Bank was severely undervalued or severely underwater. And now let's combine the two things. Bank runs start to happen. People start to swipe left, swipe right. Okay, Civ Bank now suddenly has to sell these bonds at a discount, at a loss, which just starts this death spiral down into where we are right now, into why the regulators had to step in to say, yep, okay, stop. We got to stop. We got to stop all the distributions for the time being. The Federal Reserve has to get involved. FDIC has to get involved. And as I mentioned, the end came to Civ Bank, and then what the Fed regulators do, they said, holy smokes, okay, what other banks have this high VC or high, underinsured? Like how many other banks out there have a whole lot of their depositors with, more than the 250,000 who are holding all of these bonds that are undervalued? And then they opened up all of these different lending mechanisms to make sure that the contagion is contained. As I mentioned, I'm going to digress a little bit into the other timeless aspect of this, right? Of bank runs and how much the Fed can do. But really quickly, it helped. I mean, it certainly kind of calmed things down because they really had to take these steps because this contagion did spread. It did spread, as I mentioned, into other banks. They said, wait a second, well, if Civ Bank is underwater because of the bonds that they're holding, what other banks are underwater? What other banks are having issues with, again, overinsured or, have all of these accounts that are over the limit? What about global banks? And then suddenly Credit Suisse got involved, and so you start to see the, kind of go over to Europe. First Republic was having issues because First Republic's in Civ Bank's backyard in the West Coast in San Francisco. So, okay, here we go. Now, panic and all that stuff starts to set in. But over the past week or so, things have started to calm down a little bit in the sense that, okay, well, First Republic is now in conversations with JP Morgan to have some type of buyout, almost, hey, the assets are cheap, bigger banks have money, and they can step in on the regionals. Same idea. UBS over the weekend agreed to buy Credit Suisse with some help with European regulators. So the regulators are now coming in to step in. And in fact, you saw some really interesting action in the markets as they responded to this. Because here I am kind of whipping things up, being like, oh my goodness, bank runs, what other banks are going to be underwater? And then, okay, how far does contagion go? Well, yeah, there was some wobbling in the markets, in the stock market. I'm going to get to the bond market in a second. Yeah, there was some wobbling in the stock market, but not bad. So, okay, well, I think the equity market probably would have sniffed out whether or not this was going to be that bad. Now, don't get me wrong, there were certain areas that got worked, that got absolutely crushed. So, for example, NASDAQ's index of bank stocks dropped by a quarter in the course of a week, erasing gains from the preceding 25 years. So the banking sector absolutely got crushed during this. But yet the overall equity market didn't. Now, why is that? And I'm going to come back to that, okay? Also, bonds themselves actually rallied. So when bonds rally, that means interest rates come down. And so bonds actually, people that did, deal with all the pain in 2022, bonds actually did well during all of this. And in fact, here it is. On March 13th, the 2-year Treasury yield fell. Again, so when interest rates fall, bonds go up. Interest rates down, bonds up. Interest rates up, bonds down. Okay. On March 13th, the 2-year Treasury yield fell by 0.61 percentage points. And it's like, okay, all right, so that's okay, interesting. But check this out. It was the biggest one-day drop in more than 40 years. So bonds or interest rates went down, bonds rallied. In fact, on that end of the yield curve, in that 2-year spot, they rallied the most in one day in the past 40 years. So there's a big fight to safety. However, the equity markets pretty much stabilized and didn't really sell off too much. All right, well, why? Now hold that thought, because I do have to digress a little bit on the timeless nature of bank runs. As I mentioned, is this going to be like '08? Is it going to be like the Great Depression? How does this all work, right? So I did want to talk a little bit about the Fed, because the cliffhanger ends with the Federal Reserve, okay? So let me go way back in time, and bear with me, and hopefully people are kind of enjoying the podcast and enjoying this little stroll through history here. But just to kind of let you know why the Federal Reserve does what it does and why the regulators step in, because they perform a role called the lender of last resort. So if banks start to fall, they sort of step in and kind of calm things down, save certain ones, let other ones fail. Now, there are plenty of free market and heavy capitalists that say, this is ridiculous, let the markets decide and whatnot. But the reason why they did exist is because for the half century between 1863 and 1913, there were 8 different American panics, right? So in 50 years, there was 8 different panics, things like this that happened in the 1863 to 1913. And the economy took a long time to recover. So in the 1913, that area, that they founded the Federal Reserve. And then when the Great Depression happened, they realized the Federal Reserve wasn't strong enough to kind of contain these bank panics, because as you can see, if they get out of hand, they can truly get out of hand, as they did back in that half century in this 1863 to 1913, and certainly we know what happened in the 1930s. So then the question becomes, okay, how much does the Fed step in? Because if the Fed steps in too much, then you have what's called moral hazard, right? Like, let me put it this way. Let's say Evan over here, my producer our producer is running a bank or running a company, and he knows that no matter how much he messes up, there's going to be someone that's going to step in to save him, to bail him out. Then he's going to do what's called moral hazard. He's going to take a whole bunch of risks. And that's actually why Civ Bank, there's some, whether or not there's some nefarious, we don't know. But one of the things that really stood out during the research was the fact that they didn't have a chief risk officer since April 2022, according to Fortune. So they were without a risk officer for the past almost a year during all of this. Like, okay, that's a little moral hazard, which is probably why they let them fail at that point, right? So again, the Federal Reserve needs to strike that balance between stepping in to make sure that the panic is contained, while at the same time allowing for moral hazard, allowing for some dominoes to drop. You can't let all the dominoes, go, but you can let one or two go, or at least find that right balance between the two. of letting people do whatever they want, but also again containing the bank panics and the fear that can really kick in, as I stated at the very beginning. Okay, so that's a timeless argument. So now let's go back to the modern. So here we are. Prior to all of this madness, right? It was still talking about how the inflation was sticky. Will the Fed, how high will it continue will the Fed raise interest rates? Well, over the past 2 weeks, something broke. Something broke in the system, right? Obviously, it was a bank, and you saw a lot of other, FTX and the crypto, that bubble obviously burst, to say the least. But so far, up until this moment, they raised interest rates to kind of get inflation, and it's starting to come down a little bit. But so far, the economy was resilient. The labor market was tight, so people were still consuming, which is to kind of keep the economy going. And so now it's like, okay, well, will the Fed continue to raise interest rates, which again they're meeting as we speak, or will they not because something just broke? Okay. And so all the bets and all the futures are going back and forth on this. And that's where they leave us with this cliffhanger. What does the Fed do? Because certainly on one hand, it has to get inflation under control. We have to get back closer, much closer than where we are right now, to that target of 2%. But they can't continue to raise rates if it means that the banking system and financial stability is also extremely important. And that's what's going to happen to the markets. In general, pausing, you would think, would be very positive because it was negative during 2022. When I say positive, I mean, as the interest rates went up, both equity, stock, and bond markets obviously had felt some serious pain. But if the pauses now, or if they start to, or only raise interest rates by, 0.25%, then, okay, does that mean that the interest rates rising is over and now equity markets stock markets can start to get back on their feet again? And recent calming or recent movements kind of imply that, right? Or no, the Fed says, no, inflation's more important. We have to get that down to where it is, and we will raise interest rates. And so is it 25 basis points, 50 basis points, et cetera? To be determined. But that's where we're going to pick this up next time. What does the Federal Reserve do in between that balance of inflation and financial stability? As I mentioned, something broke. Civ Bank broke. The banking system, broke. It was fixed, or at least it was calmed down as regulators stepped in. And so what do they prioritize? How do they strike that balance? And then we'll find out. We'll find out shortly, and then I'll pick it up from there. Thank you so much for listening. Thank you for all the wonderful articles that we got from our, the research, The Economist, J.P. Morgan, Barron's, etc. We'll put a lot of that in the show notes. And once the decision is made, you will be hearing from me then. Thanks again, and be well. Thanks for listening to the Retirement Roadmap podcast by SHP Financial. If you've enjoyed today's episode, be sure to hit the subscribe button so future episodes are automatically downloaded directly to your device. And if you've liked what you heard, please share the show. Create your own little ripples so we can help even more people with their retirement goals. If you want access to all past interviews, including notes, resources, and exclusive content from SHP Financial, visit shpfinancial.com/podcast. Thanks again for joining us on the Retirement Roadmap podcast. And for all the attorneys out there, disclaimers and disclosures, I'm just going to put on my super serious voice and add our own. No statements made during the Retirement Roadmap podcast shall constitute tax, legal, or accounting advice. You should consult your own legal or tax professional on any such matters. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk, and unless otherwise stated, are not guaranteed. Our investment advisory services are offered through SHP Wealth Management, LLC, an SEC-registered investment advisor. Insurance sales are offered through SHP Financial, LLC. Our advisors and insurance reps may offer clients advice and/or products from each entity. No client is under any obligation to purchase any insurance product.